Let's continue the market conversation with Barclays Head of U.S. Equity Strategy, Venu Krishna. Venu, it's great to have you back on the program. I do want to get your thoughts as we go into year end here. Likely trajectory for stocks, higher or lower?
I think we're going to be range bound. Our price target remains at 4150. We said it's going to be range bound in the middle of the year when it was at 4400, and I think we're pretty much stuck in that level. And the reason is quite simple. There is no meaningful upside catalyst from earnings. And meanwhile, finally, the market is paying attention to multiples we are paying, driven in good part by the rise in the 10-year and the volatility around that. But on the other hand, the downside risk is also reduced because I don't think we're looking at recession anytime soon. And the consumer is in pretty good shape. So I think we are in a situation in which fundamentals have to take control and earnings guidance has to improve. And that is still not happening despite a markedly improved earnings quality in this quarter, breaking from the trend of the last 3 to 4 quarters.
Real rates, are those fully priced into the market, to your point?
This is a question which has been coming a lot, Morgan. But our view is that I think what really matters is what is driving real rates, and which really boils down to inflation expectation and growth expectations. Growth in the U.S. is robust. It will probably moderate, and inflation is going to be stickier than the Fed would want, and so it will remain relatively high. But our work suggests that there's really no meaningful relationship, at least since the TIPS market came into existence in the last 25 years, between real rates and equity valuations. In fact, if you go back even further, call it 40-odd years, when we did have inflation, even then, there is no meaningful relationship. So I think focusing too much on real rates doesn't make sense. Nominal rates do matter in the sense that at some point, especially around the 5% threshold, our empirical work does suggest that the valuations start getting hit. So I would say that, that is why we're in a range-bound market where we need earnings to be the meaningful catalyst and not necessarily depend on multiples, which we have been for all this while.
Okay. So then if you're an investor, where do you put your money to work right now? Where do you hide, or I guess where do you wait out what could be, it sounds like, based on some of your commentary, perhaps more pain or at least more uncertainty here in the near to medium term?
So I think there are pockets of opportunity. Like, again, big tech is something we've been positive on since October of last year. That is the only place where you're seeing meaningful upward revisions in earnings, double digits, almost 17% for next year, over 15% this year. So that is rock solid, excellent quality in terms of balance sheets and cash flow generation, things like that. The other area we've been insisting is energy. That's somewhat controversial, but the point is oil prices are likely to remain higher, and oil companies have capital discipline, and they're focused on profitability and return of capital. And the other area which actually starts looking interesting is discretionary, given the unusually strong strength in consumption. So I think there are pockets of areas there which are worth looking at. But outside of that, I would say that it is tough to make a call for the broader set of sectors out there.